I talk with hundreds of potential business buyers every single month, and one of the biggest questions that has come up over the years, and especially quite recently, is how do we structure a deal that allows me to leverage the benefits of an SBA loan when acquiring a small business, but also be able to raise money from investors that want to invest in my deal, so that I can use other people's money or buy deals bigger than what I have the cash for. Today, we're going to break that down as well as introduce a super secret hack that we've been teaching in the Acquisition Lab since 2019. So check it out. My name is Walker Deibel. I am the Wall Street Journal bestselling author of Buy Then Build and founder of the Acquisition Lab. Basically, I started buying companies back in 2004. And when I was just graduating with my MBA and my startup failed. If you've read Buy Then Build, you know the story. But the thing is like I wanted to go out and buy an existing company, right? No one in St. Louis, Missouri was, a big Silicon Valley entrepreneur success, but there was many kind of trying to emulate it. And I was like, but why are we doing this? All of the wealthy people around here in the Midwest are doing like these really sort of unsexy cash flowing businesses and getting rich that way. And I think I can buy one using a bank loan. The SBA was not doing then what they do now. And but the SBA ultimately reduced the need for having to buy a company that had a bunch of hard tangible assets that you could collateralize. And second, it really replaced the big demand on leveraging big seller notes, which more often than not was keeping sellers from actually wanting to sell their business, okay? And so the SBA solved this great big problem saying, look, we'll give you up to $5 million to be able to buy a company with what they call an airball, right? It's a technical term, meaning no tangible assets. So a bunch of intangible assets, cash flowing business, go ahead and buy it with this SBA loan, and that's great. But back in 2004, I started hearing these small whispers that a lot of recently graduating MBA students from Cambridge and in Stanford were using what was called a search fund, right? And today we've got all kinds of meanings for that. I'm talking about a traditional search fund where a searcher can raise capital and go out and find a business over a 24-month period. I'll leave that structure for a different time. The point is this: I was actually going out and trying to soft pitch investors back in 2004 on this idea, and I won't tell the stories, but they all ultimately ended with me having very few conversations and getting just roaring laughter every single time. At the end of the day, the potential investors always said the same thing the bank was saying back then, which is, Walker, bring me the business and then we'll see what we can do, right? Like, go find a business and then we'll structure it, or I'll see if I'm interested or whatever. And the thing is I could tell that even if I brought them a business that I thought was good, it wasn't going to fit them, right? And so the concept really was very well said when about a decade later I met Jim Southern, who was the first ever founder of a search fund. And he bought a printing company, actually much like I did. But what he said was, and now he's one of the biggest search fund investors out there. But the thing is what he said was, Walker, if you are trying to pitch this idea to an investor that doesn't already invest in this asset class, it's like pushing a rope. Like, you're just not going to get anywhere. And I've experienced that, kind of firsthand. I think that, number one, search funds, especially traditional search funds, tend to be very, very specific in what it is that they invest in, while acquisition entrepreneurship tends to be very, very broad and allows for a lot of different ways that to buy companies that and profit from it that wouldn't be very good for a traditional search fund style investor. Again, SBA loans kind of bring a lot of the capital to this to sort of expand what's possible. But the thing is that at the end of the day, this is all about sort of how you think about it, right? And the thing is like, if you make an investment attractive, okay, to investors, then it's going to be something that they're going to want to invest in. And the thing with startups is they get to promise this like really high growth with this like disruptive solution and all the rest of it. Whereas this asset class, you can really anchor in sort of like private capital market returns with increased stability. Okay, and so that's really where you want to anchor. Again, today I want to break down a strategy that I've been teaching to members of the Acquisition Lab since 2019, and I'm a little scared to let it out, but because many people love to copy what we teach, so but here it goes. Basically, this all goes in the approach to the investors to begin with, right? So ultimately, if you find that you want to get all of the value and sort of like try to get them as little value as possible, that's not going to get a deal done, okay? And you can't go out there and say like, hey, I'm buying a $1 million HVAC company. We're going to 10x this thing by installing, software so it can run more efficiently. That's only half of throughput. How are you going to grow, revenue and all the rest of it? And how are you going to grow an HVAC company more than 10% a year? Like that's pretty uncommon, right? Like you have to have supernatural access for something like that. So I want you to go a different way. I want you to take the approach that if your investor wins, you win. Because if your investor believes that they like this deal enough, then they're going to give you the money and then you're going to go out and be able to accomplish your goals, right? And so you need to create a win-win. That's what I believe. I don't take advantage of investors. I never do, okay? So I never have, right? So here's the thing. SBA loans are great for this asset class. You can get, up to $5 million in capital. But the thing is that if anyone is investing capital into the business, okay, they can't actually do it after the business is under LOI and not become subject to SBA due diligence. And any investor who sort of opens themselves to SBA due diligence will no longer give you the money, okay? That's just trust me on this. Like, you can't put them through it because they're not the ones taking the risk. They're not the ones, based on this structure, that are going to be signing any kind of personal guarantee. That's what you're doing, okay? And that's why you're going to get an outsized percentage of the equity. So here's the thing. When you get an SBA loan, commonly you can get these loans with, as little as 10% down payment, cash infusion, okay? So if we have a business that we're going to try to maximize, and we're going to buy it at $5 million, 10% of that would be $500,000. Now, yes, there are new SBA regulations that say that, well, look, if you get a certain seller note, then you can put only 5% cash infusion down and all that. I'm thinking that we might get that and we might not, but usually in a $5 million transaction, the bank is usually going to require at least a little bit of a seller note, usually about 10%. And so I think that if you still have a 10% down payment, you're going to be able to reduce what I've sort of seen as normal. Like if you're buying a $5 million business that has completely intangible assets, okay, the bank is not going to let you buy it with 10% down usually. You've got to go in with at least 15 to 20% down, okay? That's just my experience after almost 2 decades of doing this. So here's what I want you to do. You're going to start a C Corp, okay, a Delaware C Corp. Now, you can do this in an LLC, you can do this in any kind of business structure you want, but a Delaware C Corp is going to be the most common in order to maximize exit value and reduce taxes, which again is going to be a different story, but reduce taxes at exit, meaning better for the investors, okay? It also means that the money that stays in the business is double taxed if it comes to the operator. Again, a little bit of a hurdle for you most of the time if you're the operator, but it's going to be a structure that sort of says like, look, we're all on the same page and we want to keep enough money in the business to operate the right way. So we're going to put this money into C Corp and we're going to go ahead and raise $500,000, okay? 500K. And the thing here is that you need to age the funds, okay? Here's the hack. If you can raise this money 2 bank cycles before, okay, you actually put an LOI on a business and submit everything for bank financing, they actually won't look at they won't look at the investors and where the money came from, because this money is actually owned, okay, by the C Corp. It's in here. And so the bank won't go back and start to, so the trick is, how do you raise $500,000 before you find a business, okay? And here's what I want you to do. I want you to say, look, we're going to value this C Corp, okay? This entity, this sort of search entity, we're going to value it at $2.5 million, okay? And so, and I'm using round numbers here, but ultimately you want to keep this 500K, under 20%. So let's just call it like, 19% or 19.9% of equity. Okay, what that means is that the operator who's doing the raise and is going to be doing the operating is getting the balance, the 81%. Okay. Yes, if you have multiple investors, they can own more than 19.9%, but I want you to keep it like this because I'm going to show you this trick in a minute. So you're raising the entire 500K, but you're raising at a value of $2.5 million. Okay, so it's about 20% loosely. Whatever. I can't do the math in my head. This is literally in my head. So so then what we're going to do is we're going to age these funds for at least 2 months. Okay, your goal should be to buy a business in 6 to 12 months. Okay, and so once you go out and you find a business, that business, the enterprise value is what? Well, we already said you're getting a $500,000 loan, so it's at least $5 million. Okay, so if you take the enterprise value of your company from 2.5 to 5 million, okay, you just doubled the paper gain of your investors' money. Okay, so in this instance, you're taking that 500,000 and you're making it worth $1 million, okay, in a number of months. Okay, if there is extra cash, okay, you need to right size. Okay, so in other words, you need to right size at closing. So you don't know what size business you're actually going to be able to get, right? So you don't know if it's going to be a $4 million acquisition. You don't know if it's going to be a $6 million acquisition, okay? But the directionally impact here is that you've doubled their paper investment. So yes, they only own, just under 20% of this business, and you own 81%, but you've raised at 2.5, aged the funds for a number of months, and then closed at 5 million. So you've doubled their money. If there's extra money, I want you to distribute it right back, right away to the investors, okay? That gets them their cash right back, and they already get the equity, don't you see? So the benefit in this point is, hey, I invested 500,000, or a portion there. I invested $100,000. And I now have $2 million, $200,000 in stock, but say it's 175,000 in stock, but I already got 25K back, in very loose math. So I get the 25K back because you didn't buy the whole thing, and so you didn't maximize the value you could get, and so ultimately I now invested $100,000. I have $175,000 in stock, and I have 20K back already in cash, meaning my investment is really only $75,000. You're already making me feel very, very good about this, okay? This is a good deal for them. Now, here, obviously you have a business plan, you have all the rest of it, and so the thing is I want you to tell these people. Now look, I get accused all the time of just being, street. I've been called street in the acquisition lab. I've been called street and when I taught acquisition through entrepreneurship at the MBA program at Olin. I don't talk about things like internal rate of return and all the rest of it. Now when it comes to a specific investment, I always look at it in hindsight, okay? I always put it in the pitch deck when I'm selling this, but I say it more generally. I say, well, this is why you should invest in things like this. Look at, again, using HVAC, here's the home services company, here's what's going on in the industry, here's, there's no technological disadvantages or threats going on. It's stable. There's all these things. If there's no customer concentration, whatever all the things are you're going to sell. But you also want to say, look, when you invest in these businesses, okay, on average, if you look at search fund data coming out of Stanford, you can see that it's a 33.7% internal rate of return. Okay. And it's about 9% of these acquisitions are getting over a 10x return for their investors, okay? So keep that in mind. Here's what you're gonna do. Instead of approaching IRR and all the rest of it, you're gonna say like this. You're gonna say, look, I'm gonna pay you back all of your money plus 20%, okay? 120%, okay? And you're the first cash out, all right? So once you pay them 120% as first cash out, meaning you as the operator don't get any bonuses, maybe a little bonus. Okay, let's not be if your board approves it. But I really don't want you to take a bonus, if I'm honest. And I want you to be very clean. I want you to take care of your investors. I want you to get them 120% of their cash back within 3 to 5 years. Okay, that's my goal for you, and what your goal should be. So anyway, will you do it? I don't know, but they're still going to be in first position. So let's talk about the waterfall. The first thing I want you to do is say, so when you draft up your structure, you say, look, the very first thing we need to take care of is working capital, okay? And sort of create a working capital peg inside your business so that you know that you have enough cash. And working capital, loosely in this case, is going to be cash flow based. So it's going to be value of inventory, value of accounts receivable minus accounts payable, okay? And I want you to keep, 90 days of operating expenses in your business at all times, okay? That will let you know if you have extra cash or not, okay? After the working capital peg that you're going to have, and by the way, you'll set that at some balance, okay? Hey, it needs to be this amount of money at all times, okay? We'll call that X, I don't know. Then what I want you to do is I want you to have an operator, okay, guaranteed payment, all right? Now, the guaranteed payment is going to be one of these things where if you don't hit the working capital peg, you don't get it, okay? You don't get it as the operator, but it can accrue on the balance sheet so that it pays to you, all right? And that needs to come first because you need to get paid for the work that you're doing in order to operate and grow this company, okay? So that you're the next person that happens here. I'm gonna go back because I actually forgot to mention a very, very important part. When these people, okay, at closing, all right, you're paying them back any extra cash. What I forgot to mention is that $500K that you raised, all right, I want that to be accruing interest in the background, okay? Don't put it in the operating agreement of the C Corp or anything like that. It's gonna be a separate subscription agreement. And that says when you invest, I'm gonna hold your money until we actually buy a business. What I want you to do is say, I'm not gonna pull any money out of it, okay? I'm gonna pay for diligence out of my pocket. I'm gonna pay for whatever. I want you to have skin in the game. I'd like you to put in 10% of this down payment if you can, okay? Oversubscribe it, okay? Because you're gonna need to raise like 500,000 to $1 million and then figure out what it is that you're gonna do once you have the target in sight, right? So you've got your C Corp here, you've got your target here. And once the target is acquired, okay, at closing, you can pay that interest on the 500K right back to your investors in the C Corp, okay? Whatever that interest was, annualize it. I say keep it low. I say keep it at like 5%, okay? Why? Because your investors are gonna double their money the minute that you buy the company. Your investors are first out right after the guaranteed payment at 120%, okay? So then comes your, preferred equity or whatever of your investors of the 120 on their money, all right? So you're gonna pay this 5% interest and they'll do it for 5% because hopefully you find a business in 12 months or less, okay? And you pay that 5% out at closing. You can't make payments from the cash because you want all the cash to make sure you close. If you close and there's no excess cash, okay, you can get a loan for working capital at the time of closing to pay it off, okay? And again, you're not talking about a whole lot of money. I don't know what that is. It's about $25,000 annually, okay? So let's say you find a business in 6 months and buy it. It's aggressive, but it happens all the time. I've done it. $12,500 in interest, okay, that you pay at closing, right? Basically the first day of operations, not a big deal. So they get paid immediately. Then they double their paper value and they're in first position, okay? I'm putting your guaranteed payment as an operating expense, okay? The other thing working capital does is it takes into consideration the principal and interest payments that you're gonna need to be operating, and that's how you're gonna calculate that peg, all right? So that senior debt obviously needs to be handled and addressed first, okay? After the investors get 120%, then it's just going to be, pari passu after that, okay? Pari passu is the Latin legal term that basically means, everyone to their percentage. So, if we take, any bonuses that you get, all right, are going to be over and above, any bonuses you take at, you're going to take an 81% distribution while they get 19. Once they get their 120%, okay, you need to understand they have all of their money back, and they have a 20% gain, and they have the paper doubling of their investment, and they got a little bit of interest right at the beginning. If you use this strategy, okay, to attract and obtain investors, and then you pull it off, they are going to be very, very, very happy, because you're really aligned with the operation of the company, the success of the company. And when you go to exit, okay, again, they made 5% of their money while it was holding. They got any extra money back right away. If there was extra, they're in first position at 120%. Every time you take a bonus, you're just taking distributions out of the C Corp. So they're continuing to take a little bit, 19% of the distributions that are coming out. And then when they go to exit, these guys are going to get, 19% of, the $5 million. Hopefully you grew it even, right? So let's say you sell it at $7.5 million 5 or 10 years later. Well, now, they're getting an excellent return on their money. Yes, we can go back and calculate that IRR, but people that are making these types of investments, this is all about cash, okay? I'll say it again, this is very street, okay? It's not sophisticated. I'm not doing a big, net present value calculation. I'm basically saying, look, invest in me, and I'm gonna take care of you, okay? I'm not taking extra money. I'm keeping the health of the company first and foremost in position, and then we're all gonna be tied together in terms of incentives for distributions going forward, and that's how you're gonna take bonuses, okay? Listen, we started the Acquisition Lab. We're the first ever accelerator for small business acquisitions in 2019 after the success of Buy Then Build. And if you are interested in a world-class experience in terms of learning how to navigate the private capital markets, buy a business, and succeed from there with world-class education, a vetted community, tools and resources. We have 11 coaches on staff for almost daily coaching. It's an excellent group, and we hope to see you on the inside. Check it out at acquisitionlab.com. Thanks so much.